Yield curve. The yield curve plots bond yields against their time to maturity, from short-term to long-term, and it's a snapshot of market expectations. Normally, it slopes upward because longer maturities carry more duration risk and inflation uncertainty. This curve is a forward-looking indicator, not just a technical chart. The shape of the yield curve tells you how bond investors feel about the economy. An upward slope points to steady growth, while a flattening curve signals uncertainty. If it inverts, with short-term rates above long-term ones, history suggests a recession may follow within 12 to 18 months, influencing everything from fixed income strategies to equity positioning and corporate borrowing. Here's an example of a steep inversion. Notice the 2-year yield is higher than the 10-year, flipping the normal relationship. This inverted curve has historically signaled markets are preparing for rate cuts and a possible economic slowdown. When the curve later steepens, it often reflects growing expectations for a recovery. To read the yield curve, analysts look at 3 key dimensions. The level tells you the general cost of borrowing across the economy. The slope, especially the difference between the 1-0-year and 2-year yields, is a classic signal. Positive is normal, but a negative slope is a warning. Curvature tracks shifts in the middle maturities, revealing changing views on growth. The yield curve is a powerful tool, but it's not a crystal ball. Remember, an inverted curve doesn't guarantee a recession, it just signals a higher probability, and the timing can vary from months to years. Also, don't rely solely on the 1-0-year versus 2-year spread. The 3-month versus 1-0-year spread matters too. And central bank policies like quantitative easing can distort the usual signals. Lastly, corporate bonds behave differently because of credit spreads, so their curve shape often tells a different story than government bonds.